Hi everyone, it's Mark here at TSLA, and yeah, unfortunately the stock didn't do so great today. And you're seeing on the screen in red numbers, the closing price was $245.01. That price is not too surprising considering the options action today, but that was a drop of $13.07 a share from yesterday, and just slightly over 5% in percentage terms. So it goes without saying, every time a price cut is announced, the stock just kind of sells off. I mean, that is a modus operandi when it comes to people that are trading or investing in Tesla. I don't know, but yeah, this is something that we have come to expect. I mean, I was talking to my friends, my Tesla buddies, last night, and we were all hyped about the Chinese release. Well, really, it was the Chinese and EU release of the Model 3 Highland, the revamped Model 3. I mentioned that in yesterday's video that if you see price action in the 24-hour market, maybe that's because the Highland was released. Now, if you look at Robinhood and look at the 24-hour market for Tesla last night, you would have seen Tesla really hit a really high point right after the release of like $263 and something cents. And it quickly sold off right thereafter because I think for some reason, the hedge funds and institutional people are on Robinhood and selling back to below 260, which is where it ended up before the announcement of not really the announcement, but the kind of the people finding out that there was very large price cuts on the Model S and X. We thought initially it was just a Chinese only thing because it was reported quickly from a Chinese Tesla account that the prices dropped severely, and then we saw that reflected in the US as well. And from that point on, it went down to 259, 258, 257 in the after hour. I'm sorry, in the 24-hour trading pre-market. You saw Tesla stabilizing a little bit. I think that was the overall market makers trying to prop up the stock before the open. It didn't really move much with the release of non-farm payrolls. It didn't drop below like 256.90 or something like that, if I remember correctly. But anyways, essentially that was being propped up, and it was giving people not really people, but the people who knew they were going to sell, an opportunity to get their hedges in at a cheaper price and then let the stock just fall, or they would go ahead and sell their shares or short the stock by short selling. So during the pre-market, I was snatching up TSLQ at certain buy orders. I think I ended up with like 325 shares on margin in hopes to hedge my position. And let's look at the price action real quick before we get to the news, which is, there's a lot of news. So I bought it pre-market, right? So I think it was right around here. I was probably buying when it was around 57 to 57.50, somewhere in that area in the pre-market. Now TSLQ is what I was buying. It's not as liquid as the stock itself. So there's a spread of around maybe 8-9 cents. Something to be aware of. Just want to let you guys know if you're ever interested in doing that. But every time there's price cuts, I go ahead and buy TSLQ as a hedge for my portfolio. So I didn't get as much as I wanted. I should have got more, but who knew it was going to sell off 5%. I figured it would, and based off our drawings, we'll get to that in a second. I didn't think it was going to be 5% at all. But I actually got out of that hedge. So it sold off and it tried to base around my first yellow line, which is the $250 to $251 mark. And we drew this earlier this week, and it bounced off it pretty nicely, bounced off it again on another sell. So I figured, I might as well get out of it. So I think I got out of it when Tesla stock was around $252, and I got out at that point of all my TSLQ. I have hedges still. So I had some puts, and I talked about this before as well. Like when you're getting into Thursday and something, and I mention it every Thursday, is that, it's possible there's a setup for Friday, because you can buy probably some really cheap options that go into Friday that with a big move that, you can get a nice return on. We're talking hundreds of percent in your favor if it goes your way, and your entry cost is much, much more affordable because it's a 1 day to expiration option from if you buy on Thursday for that Friday expiration. So I had 3 puts just to dabble, because you never know with non-farm payrolls, but who would have known that it was actually price cuts being announced after the exuberance of the of the share price during the release of the Model 3 Highland. People were really amped up. I was on a Twitter Spaces with whole Mars blog and Yaman, and everyone was loving what they saw, and there was a little bit of debate with gigacastings or what have you, but overall everyone took it really, really well. And they were really happy that, even we talked about pricing as well last night, but they were really happy that, there was a slight upcharge for the new model, just because, they figure that maybe with the demand, they can command a higher price. And also at the same time, give that differential from the old Model 3s to the new ones, because in some markets, they're going to be available next month, October. Not in the USA though. So they're not available in the USA. There's some whisperings that won't be till maybe next year. So looking at the price action again, I saw that, and this is something I really want you guys to know, and I'll just touch base on this real quick before we go to the news, is that when there are certain types of selling that is just all day. So I call it like the all day sell. And it's really simple to see. Is like you're not taking out any highs, any significant highs on any type of time frame you want to work with. So looking at let me expand the price action. So, after we bounce off my first yellow line at 251.60, like we didn't take out any of these highs. Of course, we got nowhere near the open. And so when I saw that, I think I entered more shorts. Not for that day. I don't trade 0 day to expiration really, unless I'm really desperate for a hedge. Like I'm really long in a position, like in a trade, I might go like actually 0 day to expiration, like SPX or something like that. But rarely do I do it. I think it's really gambly in that sense, because it depreciates so fast in its value because it's expiring so soon. But anyways, it wasn't taking out any highs. It didn't get close to 254. So I was like, okay, maybe I need to get another hedge in. Like it's rejecting off 254. I want a little bit more downside hedge. So what I did is I went ahead and bought puts for next Friday, because it's not taking out the highs. Now, if it would have took out the 255, I would have been like, okay, maybe they're trying to base at 255. We talk about that scenario that, $5 increments are a really big deal. So if it would have got over 255, I probably wouldn't have, if I had a short, I probably would have closed it, or had a stop loss somewhere or in that 255 area. But it sold all day, and you kind of started seeing that it wasn't taking out highs previously. It's not taking out any highs. And even to this point where it did that really nice, not really nice, but when it sold off really sharply and it kind of rebounded, it still didn't take out any highs. And it did this slight consolidation. But even at this time at 11:25 a.m., it still didn't take out a high that I'm comfortable with, which is like going to 250. And so I stayed in my shorts this entire time, which was a very long time. This was it was 3 hours of consolidation. So I was just adding, since I sold my TSLQ back up here, I was just adding shorts because I'm still not taking out any highs. Nothing was really convincing until maybe towards the end of the day, but it wasn't even that big of a move because, from the low, it's 0.9%. So if you would have held a short for that period of time, it wouldn't have been that dire if it was expiring next week. I think it only moved, maybe 15, 20%. So I still have a short going into next Friday. I didn't really want to hold too many shorts, so I closed out most of them right around here. When this little green buying area, when it broke the previous high, that's where I closed out a lot of my shorts, and I actually closed out some longs too, because I bought some longs somewhere around here, but I didn't want to go into next week with a lot of options. I just sold bigger calls, hoping that 4.5 days or so, 4 days of theta destruction will work in my favor, because a flat open on Tuesday, if it's flat, it's going to be really good for any options that you sell. It's going to be, I think I was looking at some of the calculations. It would have to, the Tesla stock would have to move like somewhere in the range of like 1.5%, to actually just maybe break even in certain situations. So if you're buying options like calls or puts into next week, and it goes in your direction or the direction you want it to go, it would have to move pretty drastically. I'm not saying it can't. Obviously, we know that Tesla can move pretty drastically, but it would have to move over 1% just to even break even on that. So maybe I didn't really want to expose myself, because there was so much downside. If I was to hold a lot of puts going into next week as a hedge, all that really does is add to my loss if it's flat or even slightly down. Let's say it's down like 1%. All those puts are still kind of worthless. Not really worthless, but they're definitely negative. So when you're looking at these patterns, like for the price action, really, if you're not taking out previous highs, you can really kind of prepare yourself for another low to be made. It might take some hours, but you can prepare yourself for another low to be made. And we kind of saw that after the earnings. So if we look at the earnings sell-off, and I highlighted here in the green, Let's go to a smaller time frame. And you can see that the significant highs were taken. So like, yeah, there was a gap down. I get it. It sold off a lot and it got bought up a little bit, but the next peak didn't equal it. It didn't beat it. So you can probably stay comfortable in the short and keep your hedges intact. You know, this is going to be, this was the next day, but you know, I would say I would have kept shorting even the next day because it's not really getting to a significant high. It did beat out that high, but this candle was very short-lived anyways. That was only like a couple minute candle and it sold off below the previous high in like no time at all. But kind of look for that when you're looking at you can feel that there's this negative sentiment when it comes to like institutional investors or hedge funds. They're selling Tesla. It's like it's selling a lot. They're going to sell Tesla a lot, and we can't, as retail, we're not going to be able to prop the stock up. It's just we don't have enough money, and we're not using all our margin. So just prepare. You know, prepare yourself on these days where there's that news that you think that okay, we have Model 3 Highland news, but the price cuts will always beat it out because the Highland is still an unknown quantity, and the market only cares about what's real right now. What's real right now is that we have a slight margin compression because these, even though it's a very small representation of the product line, we're talking 3-4% of sales. The Model S and X are cheaper by 19%. And let's go ahead and get into the news, and we'll look at that. We'll look at the news for today because it wasn't just Tesla news, even though there was a lot of Tesla news. First things first, let's quickly address the badass Model 3. So the Model 3 came out, and like I said, it's a little bit more expensive in China and in Europe, but just barely, a couple percent in the EU, maybe a little bit more significantly more expensive in China. But they have a little different things as far as incentive goes. They might even have insurance incentives, and they might have other local and their governmental incentives as well. So it kind of could be that they're just trying to compensate for that, maybe get a little bit more margin in regions that give in regions where the governments give them a little bit of a kickback. I think it looks great personally. I think I love the much cleaner look on the front end. I know some people, it's just obviously it's just an opinion, but I think it looks great. The stocks are removed on the steering wheel. They went with buttons, something you might have to get used to if you buy this car, but we might not be able to buy it in the US for some time because I don't even know if there's real evidence that the Fremont line is being modified to accept this new model. And I think there's enough people watching it, watching the factory, that they can probably spot when that transition is taking place. But there's no work being done as far as a Model 3 Highland being available anytime soon in America. Kind of a bummer, but it could be because we have a lot of inventory and they want to clear that up first. And plus, they don't want to sacrifice volume production on every region because they have a volume goal, right? Their goal is to make at least 1.8 or a little bit more million cars this year. And they already shut that line down earlier this quarter for, some tweaks to the Model Y production, of course, setting up Cybertruck, and of course in EU and in China to manufacture the Model 3 Highland. So this is really cool. I really like it a lot. I think it's great. But let's get to some news. So there was economic data drop this morning. There was a lot, actually. It was mostly about jobs. And Nick Timrose just did a quick summary for us. And it was actually really surprising. The unemployment rate rose from 3.5% to 3.8%. The economy added 187,000 jobs. And payroll growth for June and July was revised down considerably. And there's another tweet below this that will show that revision down. And let's go ahead and scroll down to that. So Nick says one more of the interesting revisions to the report is in June, just June alone, 2023. It was initially reported at 209,000, but it was actually just 105,000, being halved. And that's not great. But wages were also down a little bit too. So wages were not as high as expected. But the really surprising thing is, okay, yeah, the jobs are added, but we all know every time the non-farm payroll is reported, it's always revised down the next month. I think on average, it's off considerably over the past year and a half. But this unemployment is the highest unemployment we've seen in like 1.5 years as well. So it's kind of balanced out. So the jobs number beat. Remember, it was 170,000 expected, 187,000 was reported, but unemployment's up considerably. A 0.3% in unemployment in 1 month, that's a very large tick up. And so the market was trying to understand what they needed to do here, right? And So you might have been confused by the price action, but we'll get to that when we get to the charts. But you're probably thinking to yourself, like, if you watch yields, okay, yields are going up. The stock market went up a little bit, but then sold off. But some parts of the market are up considerably, and Tesla is down a lot. But why? If we have higher unemployment, somehow there's more jobs than expected, but the months before this have lost over 50% of the jobs they reported that were gained that the previous month. You kind of wonder, like, what's going on? And that's the thing, is the market was having trouble digesting that news. And if you were just looking at Tesla, maybe you wouldn't have seen that struggle. But if you're looking at the rest of the market, you would better understand what they might have been doing. So let's go on to the next bit of news, and which is just talking about this week as far as the flows for this week. And there's an interesting article. It was titled "Treasuries are set for the worst week since the U.S. independence," as investors bag tech stocks. I think for the past 3 years, this might have been some of the worst performance in bonds in the history of this country. And that's why all these banks and regional banks are struggling so much, is because no one can anticipate the devaluation of their assets because they're holding so many bonds is so tremendous. It's really, really, really bad. And that's why we had that whole banking crisis thing, and that crisis still kind of exists. If the Federal Reserve's programs to bail these banks out weren't in place, they would be all basically insolvent. The usage of the programs, I want to say, is somewhere like over $100 billion that people are turning their bonds in and getting cash back for the value that they purchased it for. So, and those are all temporary. Those are loans, and then they're charging interest. So these banks are not getting out scot-free, and we're probably going to see a lot of banks eventually, it might not be like this cascade, but slowly but surely you'll see banks either become maybe banks go bankrupt, or they get bought out. But it's not really that ideal to buy them out before they go bankrupt, because we've seen what happens. It's easier just to let them go under and buy the pieces you like in some type of auction or negotiation with the FDIC. But so this article says there was $10.3 billion of inflows into equity funds in the week to Wednesday. Just to Wednesday. That's 3 days. 5.1 billion of those were into tech stocks. Last week, it was reported that the exposure of hedge funds to the quote-unquote Magnificent Seven, or the 7 large mega cap stocks, the 7 largest in the S&P in the S&P 500, was the highest exposure maybe in years. And you're saying to yourself, well, the market's been kind of mixed. Well, I mean, they want to expose themselves to this because they feel that there is some upside potential to the end of this year. And most of these funds that are being put into the equity markets are really just into tech stocks. Really, really disparate performance between tech stocks this year and the rest of the market. And so just to give you an example of that. So year to date, there has been $34 billion of inflows into tech stocks. And that compares to the second place, next largest sector being consumer stocks, only $4 billion. And so essentially what's happening is the breadth of the market is very, very desperately bad. And that's what the market says as well. I mean, this article says as well. It's just everyone's putting money in tech stocks. But you're saying to yourself, like, I don't understand. Like, yeah, I mean, tech went up a little bit and it had some good days this week, but like, why is it not? Why are stocks not getting propped up? Because really, it's the hedge funds, or I don't think CTA is actually positioning it, but hedge funds and institutional investors, they're buying these stocks because one reason alone, they've read this market really incorrectly at the beginning of this year, and it's crunch time now. It's crunch time right now. You have September, October, November, December. You have maybe less than 4 months of the year to really perform. And I think most hedge funds have really underperformed the market. So they have a benchmark. The benchmark is simply what? If someone's giving you a lot of money, they just expect you to beat the market. But the majority of them are not beating the market, especially if you compare their performance to even just the NASDAQ. They're very much underperforming. They've been in bonds, which have performed terribly this year. Obviously, we talked about that just a couple seconds ago. Bonds are terrible this year. They've been in oil. They've been in energy. Now, energy's had a good run. It's had a good couple last weeks. But up to this point, energy has been very, very bad. Energy didn't make an all-time high, but Apple did, right? Nvidia did. And so they basically, there's an opportunity cost for being positioned in a very kind of recessionary way, being in bonds, being in gold, being in oil, and they're really paying the price for it. So they're looking for that opportunity now. There was an August dip. So the past couple of weeks, they've been just loading up as much as they can on tech stocks because they hope they can get some outperformance somehow, some way. The reality is a lot of them have been in cash, but a lot of them also have been in bonds. So if your money is tied up in bonds and hasn't been performing, and you see a little bit of a dip in the tech market, what do? Maybe you sell bonds and buy tech. And we'll look at that later in charts. Now, let's get to some more Tesla news. This is from Electrek. Tesla drops the price of Model X. Now the Model X qualifies for US tax credit. So yeah, this is the reason why the stock dropped. Because yes, I understand that the Model X and S doesn't represent a large portion of sales for Tesla, but it's more about it's more about a sentiment thing about, is there a demand problem for the cars? Now you can say, and you can make any argument you want, but what the market does, they're just working with the information they got. And we've seen that the production for the Model S and X this year has been very consistent. I don't know, is it something like 10 or 19,000? But it's consistent numbers. But the deliveries for those have always fallen short of their production. And you can only imagine there is inventory being built up for these cars. And the demand for them domestically in the United States of America, where they're manufactured, isn't very high. You're actually seeing demand, in other regions more so than in America. But they need to get rid of these cars now. They want to get rid of them for the quarter. And so they're going to discount them. And I think, this is something we should have had kindly thought of, but we never really addressed that. We're always saying, okay, in quarter two, deliveries and production was pretty close, but we also just kind of conveniently forget that delivery and production in the first quarter was only half, right? So the article says, Tesla has cut prices on the Model S and X. This drops the price by 15 to 19% in the US in all trims. This is long range. This is plaid. Except for the brand new standard range model, which was introduced over 2 weeks ago, that thing has been discontinued. So the standard range model, which was the software limited S and X, that's gone. And it probably was because they just didn't have any demand. They were, 78,500 and 88,500. But now you can just get the regular S and X basically for less than that now. So the standard range was more expensive. Now the new base models, which of course have more range in their standard range, quote unquote, now are cheaper. The Model S being $74,990 as the base price, and the Model X being under $80,000, which is super key because that allows an SUV to qualify for the full $7,500 IRA rebate from the federal government. So that was an $8,500 reduction in price. Now, by the way, if you go ahead and go to the website and try to build it, you just know you cannot add any options to the Model X. Otherwise, it goes above 80,000, and you have to just buy it as is. Otherwise, you don't get the credit. The Model S, unfortunately, it doesn't have. It's well above the threshold for the IRA. It's $55,000 for sedans. It's $80,000 for SUVs and trucks. So, unfortunately, the Model S, if you want a Model S, you have to pay $75,000 as is. Now, the good thing is that the plaid versions have also dropped. So at the bottom of this article, it says both vehicles' plaid versions have dropped in price from $108,490 to $89,990 today. This is crazy. This is tens of thousands of dollars off the highest performing model, and probably one of the highest performing models just available to the world. It is a much more affordable situation, and it really puts pressure on a lot of manufacturers in their high-end offerings. That how do you compete when these cars are much more, like, even just thinking about the base. If you just think about the base versions, like they already perform better than, let's say, a Lucid. And a Lucid, recently did like that kind of targeted lease offer or price reduction a couple months ago or a month ago. Now they're extending that because this is really threatening for them. Like people can buy a Model S or an X cheaper than than a Lucid Air, and then you'll have more performance. You'll have thousands of dollars in savings, and it's like, why would I buy a Lucid? And this is going to put a lot of pressure on, maybe the high-end versions of the Cadillac EV or something like that. So those high-end versions are going to be in a world of hurt. We talked about how the government is, bailing out legacy auto manufacturers. Legacy Auto is getting billions of dollars in the form of new support, quote unquote, really. But it's really just bailouts from the government, allowing them to retool their factories to manufacture EVs and also cover them in case of a strike. So you probably, if you follow Tesla closely, you know that our competitors in America, the workers and the laborers at those companies are under a labor union of some type, maybe Teamsters or what have you. And they're in a possible strike situation because they just gave permission for their union to do a strike and they gave them that permission to do that. So whenever the union wants to call a strike, they can call a strike. And the GMs and the Fords, they're not making any cars. So the government gave them a couple $2 billion to provide extra monies for union employees. Unfortunately, this is crazy because this is really free money, okay? And I talked about this in a tweet or a post on X that the federal government's really going after Elon, and we're kind of paying the price for it. The federal government subsidizing Ford, GM, and Stellantis's transition into the EV market, yet Tesla had to do it on their own. They had to handle the ramp on their own. They had to learn all that on their own. And all these companies in America that manufacture ICE vehicles still are getting basically subsidies from the government to keep them in business, essentially. And the reason for this is because the Biden administration just doesn't like Elon Musk. And you can think about it then, yeah, I mean, they're just trying to, appease their voter base because most people who are in unions vote Democrat. I get that. But it's not surprising that Elon Musk is under investigation for a glass house. We talked about that a couple of days ago. We also talked about at the same time that SpaceX is being under investigation for not hiring of asylees and refugees. These cases, they're ridiculous. They're insane. And it's just to give Elon a hard time. It's to distract him and create a narrative in the mainstream media that Elon's a bad guy and his businesses are bad businesses. There's a lot that goes against us when it comes to the short-term price action for the stock. And unfortunately, there's really nothing we can do about it unless there's a change in administration, or really that just based off the merits of the companies alone, they just outperform and destroy these people. Okay, so we talked about the news. We got price cuts. We got a new model. Let's go back to the charts. So we talked about yields earlier, and we can take a look at the yields. And you can see that the 10-year had this really big candle over here. And we kind of anticipated that. We figured that it'll be creating a head and shoulders type of situation where, it sold off a little bit and it was kind of quote unquote oversold. And so the bounce necessarily, wasn't anticipated in this extreme, but it was kind of anticipated in the sense that we thought that it would actually form a right shoulder and maybe reject off the 420, like 4.2% yield on the 10-year and come back down and test this upwards trend line. So maybe, by the end of the second week, we'll be somewhere around 4% on the 10-year. The 2-year also kind of went up a little bit. It sold off more than the 10-year, and it didn't get as high on the day as the 10-year. So that could be a good sign that the 2-year yields are coming in. But at the end of the day, yeah, not great for equities when yields are going up in the face of what could have been good data for a market rally. TLT represents the fund that tracks the long bonds of 20 and 30-year treasuries. And we talked about how this could be a double bottom situation. With this type of news that we got today, this could be a perfect setup for a long into TLT. I can't tell you when that timing is, and this is not financial advice, but we kind of thought that this would have to have a test. And so the sell-off happened in TLT, meaning that the 20 and 30-year rates increased a lot. I want to say it was like over 1 point something percent. And so TLT paid the price for it. But it would be very similar to the bottoming process that we saw for bonds back in October, where it looked like it bottomed, it had a nice rally up, and it kind of at this exact same level around 97.50 kind of sold off a little bit. So we can see maybe a gap fill on the long bond. Maybe you get TLT down to 93.5. Hopefully not. Like, we don't need to fill that gap, right? We don't need to fill it. But you might see a slightly more pressure, and then if the market does what we think it's going to do, which is that they absorb the information, they understand the labor market is really soft, in some way. Like, I mean, that's how we perceive it right now. And if the market agrees, eventually TLT will go up, meaning yields will come back down. But for now, so why would yields go up? Like, why would yields go up? Well, the answer is, we were talking about how there was a lot of bad positioning when it came to funds for this year, where they were very heavily in favor of this idea that a recession will be happening in the middle or early of this year in 2023. That never materialized. And so what happens with that? Like, what do you do with that? And what you do with that is, if you're so heavily positioned in TLT and you want to get back into the market, you just have to sell your bonds. You need to sell your TLT, and then you can get the cash and buy yourself back into this market and hope you can find a rally that gets you a couple percentage points to make your fund have some type of performance before the end of this year. We know that October going into November and December usually are very good rallies seasonally, where there's a bottom sometime in late September, middle September, or early October, and then the market gets bought up into Christmas and gets sold off maybe into the end of the year, but maybe those funds already deleverage at that point. So you can kind of see how even though, yes, typically when stocks are going down, yields would be going up. But at sometimes you're seeing the yields go up and stocks kind of maintain themselves. So, and let me turn off this TLT comparison. I don't know why I have that here. But here's the S&P 500. And the S&P 500 had a green day today. It closed up 0.19%. So it wasn't like it sold off like Tesla did. We might have a skewed perspective on how the market performed because maybe we focus just on Tesla. But, yeah, so the yields were going up during the course of the day, but eventually the S&P 500 bottomed out and found a little buying and closed in the green. And so you're saying why? Well, like, if the yields are going up, what does that mean? Yields are going up because people are selling bonds. For people to buy bonds, again, yields need to be higher to be more attractive, right? And if they're going to be sold off, then yields go up. What do you do with the money? Now, I think what's happening is some of the people are just using it and they're holding cash for now, and they're going to start buying back into this market. And they needed the money to buy back in this market by selling their bonds, by selling their TLT. And so they're doing that, making the yields go up temporarily. And what you want to see is a pullback in the yields as we get into the middle of next week. And as they start positioning themselves to be long, that the hope is that the softening job market means that rate hikes will no longer be factored in for the rest of this year. Or even where a lot of people are, a lot of talking heads are saying is that there is no more rate hikes now for this type of an unemployment number coming in. Now, the debate is that the unemployment number is high because of kind of like not really market issues or economic issues other than like these isolated strikes. So you have like the Hollywood strike, or you have the people at the yellow freight trucking company being unemployed in the tens of thousands. That could be temporary, and the possibility of other automotive related temporary quits or what have you. So the unemployment, if that's a real number, and if it reflects again next month, that's going to be a really good sign that rates are not needing to go higher. Okay, and we are also seeing those downward revisions in job creation every month. We're seeing ADP miss. We're seeing job openings come down severely. So the market wants to shake you out. Now, the Tesla movement is not the market shaking you out. The Tesla movement is simply saying, I don't want to be in Tesla. If I'm going to get my returns, I'm going to get them somewhere else. And where are they going to get it? Well, I think we should look at the other sectors of the market or other indices that track different types of stocks. Here's a comparison chart. We have four tickers on this chart. So the candles here in the middle, this represents the Russell 2000, which is the IWM ticker, or the US 2000 CFD ticker. The yellow line is KRE, which represents regional banks. The orange line is going to be the S&P 500 through SPY. The QQQ represented here is the lowest performer, and that is the NASDAQ, the tech stocks. So looking at this, this is a comparison that obviously KRE and the Russell outperformed the S&P 500 and definitely outperformed tech stocks. And they didn't necessarily make the lows that the other indices were making. So looking at the Russell, you can see obviously that there is a low and kind of a double bottom here early in the morning, but it never met that low again. And when the S&P 500 made a low and the NASDAQ made a low, they made further lows and actually double bottomed on the course of the whole day's price action. But the double bottom for the Russell never really happened in the same way. Everything had a double bottom in the morning, and the other indices had double bottoms during the course of the day, like I mentioned. But the Nasdaq the F Russell did not make another low. So the lows, the secondary lows would be here in the middle of the day around 12 o'clock at lunchtime, and that low was never met by any other price action for the rest of the day. Now you're saying to yourself, okay, Tesla's selling off, the tech stocks aren't really doing well. What's going on here? Well, these are all just rotations, and people are trying to find performance. And the Nasdaq has been bid up quite a lot this year. The S&P 500 is doing decently well when you look at it from a year-to-date perspective. But the Russell 2000 has always underperformed. So every time there is this kind of glimpse or hope that the rate cycle has ended, you'll always see the small and micro cap type of stocks outperform, because they're hoping now that, okay, these companies are not, number one, they're not going to go bankrupt anymore, because the cost of doing business for them, just staying alive, with these rates this high, is almost impossible. We're having a lot of bankruptcies this year. You just don't hear about them because maybe there's not big enough companies, but there is a lot of bankruptcies this year. And these small companies, small cap companies, micro cap companies, they cannot survive. They cannot do it. But if rates have now bottomed, or topped, I'm sorry, if rates have topped, they have a chance to survive. And that's where the fund managers of the world are looking at the market. They're like, okay, tech stocks, they're up like 300%. S&P 500 is maybe up like a couple of percentage points, but the Russell is flat. That's where I'm going to find my movement. That's where I'm going to find the returns to save our fund. So by the end of this year, we don't look so bad. Another really rate sensitive part of the Russell 2000 are all these small regional banks. These regional banks have been really hurt because they've been suffering the most when it comes to the rates in this rate cycle. If you think about Tesla and you think about, consumers, yeah, I mean, no one wants to spend 8% to buy a car, but they manage to sell cars still. These banks are on the verge of just going under. They don't have any liquidity. If there's any little bit of fear that their deposit base isn't be able to withdraw their money, even if they're backed by the FDIC, that doesn't matter. They're pulling all their money out and going to JP Morgan, right? So let's look at KIRE, which is much more sensitive, like I said, to rates. And it just made kind of some higher highs throughout the course of the day. It sold off a little bit, but it actually did very, very well. Much better than any other ticker on this comparison chart. And so I want you guys to know that we're really wrapped up in a Tesla story, but the market isn't as bad as we think it is. And I hope we don't, you miss the forest through the trees, because around Tesla, there is ways for you to hedge yourself. There's ways to take advantage of the market. And by the way, guys, yeah, we had a good rally to this point, but we're still not at all-time highs on indices. I just don't want you guys to miss out on the rally that could happen. And you look back on this moment and you're saying to yourself, okay, I've been waiting for Tesla to make all-time highs, and it's been 3 years. And then you look at the rest of the indices, and they're already let's say it's December at the end of this year, and they're all making new highs. And what if Tesla isn't making new highs? Because what happens at the end of this quarter? What if they report a margin compression? Maybe they're around 16%, 17%. What do you say to yourself then? Because you just wasted 3 months. You can easily say to me, okay, I understand, but I'm a long-term investor. You don't think everyone else in the market are long-term investors too? But the thing is, they're making money. Remember, if you overlay S&P 500 from December or January of December 2020 or January 2021, the S&P 500 is outperforming Tesla. The S&P 500, which barely moves per year, right? If you're a long-term investor who's been trying to get into this story, you've heard about, Tesla becoming more profitable, and at the end of the decade, and you want to get in the stock, maybe you're not doing that great compared to other tickers. Maybe you're not doing that great compared to the market. So I just don't want you guys to miss it. I'm not saying we're going to go up forever. What I'm saying is that, can Tesla go up forever right now? Maybe not. I bet you could probably, if you're objective with me and yourself, you can probably lay out a case that the stock will be very choppy for the next year. But if you look at the market and the end of rates is near, could you make a case for the market just kind of slowly going up for the next year? I think you kind of can. especially if you're talking about small cap stocks, it's really depressed stocks like, quote unquote value stocks, or even the regional banks. The movement in those stocks can be much higher in percentage than Tesla is in the same period of time. Because Tesla's just up and down like crazy. Intraday, intra-month, intra-week, it doesn't matter. It's going up and down, and maybe it nets, a couple percentage points. Because you can say like, oh, but year to date, Tesla's up a lot. But it's just because it just happens that the market bottomed towards the end of last year, where in other situations, when you can do year to date comparisons for charts, that the bottom was like September, and it stayed flat. I'm sorry, it started, bouncing at that point. And so when it got to the beginning of the year, it stayed flat. And it looks like, okay, year to date doesn't look good, but maybe 52 weeks back, it does look good. And that's the thing, is that when people use that year to date comparison or time frame, yeah, it makes Tesla look good. Tesla's still 40% down from all-time highs. Apple is like 1% down from all-time highs. I also want you guys to remember that. Don't miss what are sometimes once in a generation opportunities to get into something, and get into something that's just an index. I'm not even asking you to find the ticker that will 10 times. I'm just saying there's things that are performing still where Tesla's not. So look at the chart again for Tesla. And let's go on a small time frame. And we can see how we drew those scenarios. And the scenarios were just based off the $5 increments, like I mentioned at the beginning of the video. So we figured that, okay, if non-farm payrolls was going to be good, I just didn't think we'd get a lot of movement. I was hoping that we just get above 260, maybe bounce off 262, and just kind of end on a day that's flat, because Fridays aren't really great days. And especially the calls were really, really bad today. Really, really bad today. Anyways, Friday expiries, it's probably best for the market to make an initial move and just not do much throughout the day, other than to try to achieve its quote unquote max pain, which is based off the options flow, like where the most interest in calls is, where the most interest in puts is, and kind of it will fight between those two points in strikes. But we said, okay, but what if like non-farm payrolls is really bad? We kind of drew out scenarios where we might have bounced off the 252, 251, or bounced off the upper EM estimated move, which was $249 for this week. Now, okay, so it sold off, and it wasn't because of non-farm payrolls. This was a sell-off because of price cuts. So what do you do with that information? Okay, so it bounced off our first line, which is simply just putting a line at 250, essentially, because the stock likes those round numbers. And it bounced off a little bit, but didn't make a new high, and sold off right through the EM. It didn't even care about the EM during the sell-off, but it did care about it when it wanted to bounce down from it. So it bounced down from the upper EM. And so now we have an inside week where we are all thinking that, okay, the estimated move being 4% up and down from last Friday's price, we're well above that. We blew it out of the water, and we're going to end outside of the estimated move area. And it did not. We went right back into the estimated move. And so maybe it's not all too surprising. But where did we find support again? We found support at 245 because it was just simply a $5 increment. And we found support again at 242.50, which is just another strike in options. So when you're thinking about, if you're in a trade and you're thinking about how, where is Tesla going to move next, you can bank on it just bouncing around, bouncing off of, or bouncing down from the strikes for the options, which are $5 increments or $2.50 increments. And then you can kind of gauge okay, so right here, it's going to bounce down. It's not going to go back to 250. It's not going to go back to 249. And it's not making a new high. It's probably going to go short, and you can keep and stay short. And it's getting towards the end of the day. Let's say it's the last hour, the last 30 minutes, and you're asking yourself, what does it want to do? Well, it bounced off a strike of 242.50. But it starts getting bought up a little bit. But there's not a lot of time in the day necessarily for the stock to move, multiple percentage points. So maybe it's just trying to get to that next strike, which was the $245.01 close, right? It was right above 245 because there's too many puts that they didn't want to pay out at 245 even, right? So you can kind of just on Fridays just kind of base it off that. This doesn't really work all the time for non-expiry days because sometimes it doesn't necessarily matter for it to get to some point, because on Thursday, Monday, Wednesday, Tuesday, there's no options expiring. So, but we did see resistance of 260 throughout the week, right? We've also seen resistance at the 242.50 point and 242. You can kind of see it here, where the resistance doesn't really necessarily make sense, but because it's not expiring on those days, but you can just on those strikes, it can provide just an easy, quick guess of what resistance might be. Okay, but we did end up back in the estimated move, and so all the options that were sold didn't lose the sellers all that much money or made them a decent amount of money. But I was really thinking that it would actually hold on to our red line, bounce off the EM, and try to close outside. It didn't, unfortunately, but it did. This is the thing. The scenario is, if it's going to sell, it's going to keep selling. That's just the gist of it. And that's something I want to kind of drill into your head, is those moments where Tesla starts selling, sometimes it just doesn't stop. And if it does stop, it's going to stop at some type of strike point, most likely. We've seen that happen here, where it sold off in the morning on Tuesday. It went below this level, okay, but bounced off it. Got bought back up, bounced off it, and made another high eventually. Now, so you can kind of set up your levels and take your hedges off as the price drops and hits levels. You can start taking your hedges off, and you realize your profit. And I don't necessarily want to imply that you should play a bounce, because you never know with Tesla, right? Sometimes it'll bounce, and maybe it bounces, and that'll be a great play. We saw some great plays right over here on Tuesday into Wednesday, where that move was really, really good. But just kind of be aware that, you want to scale out of your position, even your hedges. Like, your hedges only work if you're taking profit on them, right? You don't want them necessarily to go into expiry and expire, not necessarily, right? But anyways, really unfortunate. And I hope that, there's a little bit of buying after hours, but really not that much. I really hope that, this was just a move that's just allowing the market to digest the price cuts. And maybe they'll come to a realization that, okay, guys, they're charging more for the Model 3. And yes, they're charging less for the X and S, but those only make up a couple percentage points. Like, if they're going to sell 450,000 like Model Ys in a quarter, and they're maybe going to sell like 10,000 S's and X's. Like, that's how small the share is when it comes to it. So it sucks, but the market is just using that as a gauge for the overall demand of the product. And maybe they're not wrong. And the thing is, we won't find out until deliveries and production is reported. And unfortunately, until the next quarter report is reported. What does that mean? That Tesla can be in a chop, that isn't participating in market rallies necessarily. And that's problematic. So I just want you to expand your horizons. If you're in this ticker, like I say, prevent your downside when you can. And when it's going up, just let it go up, okay? You can hedge upside movements if you're selling calls. We talked about that already. But I think it's been very prudent that selling calls has been a very lucrative way to create income and use your investment to actually make money, where it hasn't necessarily made money if you bought within the last 3 years, kind of. So I hate to be such a downer, but we don't really know what's going to happen on Monday. I like to think that the market looked pretty decent overall, and that the data recently, over this whole week, really has really led credence to the idea that the rate hike cycle has been completed. Some economists and analysts are saying the same thing, and not just like Twitter analysts, but I mean like, people that do it for a living. You can watch them on CNBC, you can follow them on Twitter, but don't be surprised if you see a lot of people pointing to the idea that either one, the rate cycle has ended, or number two, they're going to a recession. I don't like the recession part. I think if there was a recession, it already happened last year, and recessions are you can only really call a recession after it's already happened, or you're in one that's really, really deep and deep and long. So I don't have an idea of what's going to happen next week. It's 3 days. There's going to be so much potential action or news that can drop. Elon was pretty quiet, this week. He didn't really talk too much about Tesla. He barely mentioned the Tesla Model 3 Highland release. I think he might have responded to someone with a firecracker emoji, kapow, or something like that in text. So I always say all the time, I love the company. I love Elon a lot. I think he's great for humankind. But I really wish there was a concerted effort to talk up the stock more. Not really talk up the stock. How about you just talk up the offerings, talk up the new products, talk Tesla. And he talks a lot about X and the politics of what's going on, and that's all fine. I don't have a problem with that. I actually agree a lot in terms of the politics that he has. Like, I mean, very similarly minded. But when it comes to business, I wish he would talk shop with Tesla, with the crew. And I know he did that with FSD, so I can't hold it completely against him, right? And I know he came through for the Hardware 4 guys in the clutch, and they were satisfied within a day's time. But I hope he just talks more about the new model, talk to us about what's different on a technical aspect. Like, is there a gigacast things? If not, how is there all these efficiencies made? Why is it a little bit lighter and stuff like that? But yeah, it's Labor Day for us in America. Markets will be closed on Monday. If you need to have an idea of like what to do when the Monday open is, I think the long is better done in other tickers. I think the long, there's a lot of suppressed names that if there's a rate hike cycle that is ended, the small cap names will be a little bit better than longing Tesla. I think longing things that are severely depressed because of economic conditions could be better. Nike and Disney and PayPal, like those type of stocks have had drawdowns for like 10, 11 days sometimes. Like, I mean, that's like worse than Tesla. Now the percentage terms, not so much. But Tesla had a decent bounce for the week. If you look at it just as a whole week, at least we're maintaining the trend. You can see that in the pink line, Andrew, that ever since we gapped up, we've maintained the upwards trend, and we're actually sitting on that trend line now. You see here's the gap up. You can see touches on this trend line, and we're still above it, and we closed above it. We didn't close on it. But that could just be more of a factor of the strike price that people were trying to achieve on the expiry day. And but for now, I say this: if the trend remains, if you're still above, come Monday, if you're still above 243, 242, I mean, cool. If you feel, if there's a gap up on Tuesday, I'm sorry, I might be willing to add a hedge pre-market or on the open. And if you start making new lows and turning this into a head and shoulders pattern, which we don't want, actually, let's clean up the chart a bit. It's really, really messy. So we fell from a triangle. So we talked about a triangle. We fell from that. We fell from that. So that was a breakdown. It was kind of like a UTAD. It was upward thrust after distribution type of pattern maybe, or it's just simply a fail of the triangle. So we will delete all these predictive lines we drew. I'll have the new EMs out, but to figure it's going to be anywhere about 4.5% up and down from this point where we closed. And we don't want it to do this, right? We don't want it to do, and it's, I've been talking to some people, my friends are all counting on this type of movement. They're counting on a head and shoulders, and with that kind of like angled neckline, that if you don't, I would say if you don't make a higher high on like on 254, maybe you get the completion of a head and shoulders pattern as we get into September. We kind of look at the seasonality of September. There is kind of like a dip towards the beginning to the middle and a rally into October into the end of the year. I mean, it's a possibility. We don't want to see it, but I will say this: if you see 250, I wouldn't be all that hesitant to add a longer dated hedge or two at that point. If you see some bullishness that keeps getting bought up into, Wednesday for a day or two, you can easily get back into that to 250 or so. And it might be, the thing is, it might be really quick. We talked about this before, is the move might be really fast. Fast is like what we saw from this peak in pricing yesterday when it went above the range and immediately sold off after hitting like 261.90 or something like that. Sold off, and that move, if you caught that move, that would have been a 6.9% move. So be clear, to be clear, the move can be really, really quick. And you need to be really quick by either setting orders at that point to go short, or to just be watching it like a hawk if you have the time to do that. If you don't have the time to do that, selling calls would have been perfectly fine. you actually probably would have been just fine. If you sold calls last week, I bet you were able to close that call out for if not a small loss, at least a decent profit if you're selling at a good time. Okay. Thanks so much, guys. I appreciate you guys listening, and we'll reconvene on Tuesday.